I've been investing for about 8 years now, and over that time I've been able to build a 6-figure investment portfolio. But if I had to start investing all over again, here are the questions that I'd be thinking about. Why I invest? Where do I invest? What do I invest in? When do I invest? And how much do I invest? By having an understanding of the answers to these questions will help formulate some kind of investment plan to follow over the long term. And in today's video, I hope to explore those very questions with you. But first, this video should serve as an educational guide and should not be construed as financial advice. Nothing within this video is an investment recommendation. Always do your own research, and when you're investing, your capital is at risk. There was this wild statistic going around earlier on this year that there's over £280 billion in bank accounts paying no interest. Whilst it's bad enough that that cash is earning no interest right now, it got me thinking about how much the British public love saving cash. And I completely understand why. It's safe and the nominal value of it never changes, which makes it fantastic for short-term savings goals, like saving for a house, saving for a new car, or perhaps even an emergency fund. But the downside to holding too much cash is that the real value of it actually declines over time. £10 worth of goods in 2020 cost you £10. But that same £10 worth of goods today, based on the Bank of England calculator, would cost me £12.81 because of something called inflation. Might not seem like a lot in nominal terms, but that's a 28.1% increase in prices. It's a silent economic force that erodes the value of your cash over time, and has done since records began back in 1209. Now, as at recording, CPIH, which is Consumer Price Index plus housing, or in simple terms, the inflation rate, is 4.1%. Meaning if the value of your money right now is not growing at 4.1% or more, then you're actually becoming poorer. So what exactly do we do? Well, ultimately, I need somewhere to put my money that can outpace that rate of inflation in order to increase something called my real wealth. And one of the ways that you can potentially do that is through the means of investing. Here I have the Global Investment Returns Yearbook of 2025. It's a paper published by Dimpson, Marsh and Staunton, which looks at 125 years of stock market returns. And it shows the real returns of the US and UK stock market have been 6.6% and 5.4% respectively. These are the two places that have outperformed the rate of inflation over the last century and a quarter. And whilst past performance is no guarantee of future results, the facts are in the data and they're quite hard to ignore. And that might make you think that you know the answer to the next question, but all isn't as it seems. A combination of UK and US equities may seem like the obvious answer here. Or perhaps even just go all in on the US stock market, given that that country has been the top performer. But in my opinion, there's a few more things to consider here. I, for one, have no idea which country is going to be the one that performs the best over the next 12 months, let alone over the next 30 years, which is the context of my investment time horizon. And if you've ever watched the video The Changing World Order on Ray Dalio's YouTube channel, you'll know exactly what I mean by this. And if you haven't watched that video yet, I'll leave a link to it down in the description below, and be sure to go and watch it after you finish watching this video. To demonstrate this, if we look at the Global Investment Returns Yearbook from 2023, there is a very interesting chart that actually shows the global share of equity markets from the 1900s to 2022, which I find interesting because it clearly shows the evolution of the global stock market over time. In the 1900s, the UK was in its heyday, making up 24% of global equity markets. But in the roaring 20s came the rise of the United States, until the Wall Street crash of the 30s, of course, which slightly derailed their superior dominance. Nonetheless, the US regained momentum and their dominance continued throughout the 50s, 60s and 70s, until a period of high inflation. A recession and political uncertainty then diminished their market value once again, only for Japan to take advantage of their downfall, significantly growing their share of global equity market value in the 80s and 90s, only for that bubble to burst and the US began to take dominance once again. Now today, based on a market-weighted Vanguard FTSE All-World Index Fund tracker, the US makes up over 63% of the global equity market, with Japan on 5.8% and the UK at 3.5%. What's interesting to note here is over a relatively short period of time in history, just how much has changed within that period. The changing world order, if you like, in the words of Ray Dalio. And I'm by no means a market expert. I'm just a normal dude looking to invest my money to grow my wealth in order to be able to achieve my retirement goals. So because of that, selecting a given country or perhaps even a given industry or perhaps even a given stock is going to be difficult at the best of times. So with that in mind, when I'm investing, I'm generally looking at 3 pieces of criteria. The first being, is it simple? Meaning, can I get broad market diversification with one or few investments? Because few investments means less to oversee and less to manage. The second being, is it diversified? Meaning, have I been able to achieve that broad market diversification? The third being, am I paying low fees? Meaning, are the associated charges with that investment ultimately small, ideally less than 0.25% as an ongoing charge rate, because those investment fees can massively eat into your long-term investment returns. So keeping them to a minimum is super important. And whilst there are a number of different investments that can be made, and myself, I've got a whole variation of them within my investment portfolio, the one core component that makes up a huge chunk of that portfolio is a global stock market index fund tracker. It's a fund that hits the mark on all of these 3 questions, so let me show you exactly where you can find them. As many of you know, I use an investment platform called Trading 212. They're an FCA regulated company which I've been using since 2020, and I've partnered up with them for today's video. The account that I use is the Stocks and Shares ISA, which allows me to invest up to £20,000 per tax year completely tax-free. This means that when I invest my money and hopefully make a profit over the long term, I can withdraw some or all of that money and not pay a single penny in capital gains tax. Oh, and if I earn dividends from my investments along the way, then I don't have to pay any tax on those either. It's important to note this because the general investment account, which is also available on Trading 212, is a taxable account, so be sure to pick the right one so you avoid paying any tax in the future. Now, to find equity market trackers or other investments of your choosing, you can sign up to Trading 212 by clicking on the link down in the description below or scan the QR code, which I'll put up on screen here. And once you've completed onboarding, you'll also earn 1 free share valued up to £100. Or alternatively, if you have opened an account within the past 10 days, then use the promo code Mitch and you'll still be able to get that 1 free share. And once you're in the app, you can click the search icon on your screen, click on equity ETFs, and then a whole list of different options will become available. Some of these just track one market, like the S&P 500 is the US stock market, or the FTSE 100 is the UK stock market. Now you can find out exactly what's in these funds by then clicking into them, scrolling down to the bottom, and you'll be able to see what the asset allocation looks like in terms of the individual holdings. You'll be able to see how it's split across sectors, along with how it's split across countries too, if it's a global fund. You can also take a look at things like volatility, which for this fund specifically is low. And you can also check out things like the ongoing charge figure, which is currently 0.22%, meaning if you'd invested £1,000 into this fund, it would cost you 22 pence in fees. You can also check out whether it pays a dividend or not and how frequently it gets paid out, which in this case is on a quarterly basis. Now, I can't tell you what to invest in here, and you should always go and do your own research. But when I first started out, I invested £400 in a couple of broadly diversified market tracking ETFs. And whilst that's certainly not the approach for everybody, it is the approach that worked for me based on my own risk appetite. With the markets moving so erratically in 2025, as admittedly they do in most years, a question that's often asked is, when do I invest? Do I invest when the market is up, and do I avoid investing when the market's down? Or do I even look to sell my investments when the market's down in order to buy back in when the market's performing a little bit better? What exactly is the right approach to take? Well, let's discuss why timing the market can be a problem, and we'll also discuss a couple of different investment strategies and the benefits and drawbacks of both. From a market timing perspective, there was research done by JP Morgan which analysed what would happen to an investment portfolio if you'd missed the best days within the market over a 20-year period up until February 2025. And the results are quite the eye-opener. If you stayed fully invested, you would have achieved nominal returns of 10.6% per year. Missed the best 10 days though, and your returns declined by about 40% to just 6.37% per year. Missed the best 20 days and you can say goodbye to 60% of the value of a portfolio with returns of just 3.69%. Missed the best 30 days and you might as well just keep that money under your mattress because you would have only achieved returns of 1.53%. This just goes to show the very importance of not trying to time the market. especially during the bad times, because invariably bad times are followed by good times, and that's at least as the data suggests anyway, with the best 50 days over the past 20 years have actually come during a bear market. Certainly an interesting statistic, but it probably makes sense in that volatility usually clusters. Where the market's doing some wild things, sometimes those swings can be as big to the downside as to the upside. So what exactly are our options when it comes to investment strategy? Well, one of the most popular ones, which was popularized by Benjamin Graham, who was the author of The Intelligent Investor, is one called dollar cost averaging, or if you're in the UK, pound cost averaging. It's a bit of a heavy read if you're a first-time investor, but it might be a useful book to read nonetheless. However, for me personally, I actually learned about this very strategy in this book called Money Master the Game by Tony Robbins, which is certainly a little bit more beginner friendly. And the way this strategy works is that you invest into the stock market during regular time intervals, whether that's weekly, monthly, or perhaps even quarterly. For me personally, I invest monthly once I've been paid. And from this strategy, it means when the market is up, I'm investing, when the market is down, I'm investing, and then over time, I should approximate very close to average market returns. And there are some benefits to this strategy in that it provides you with time diversification, meaning you've spread out your risk over time. And it also mitigates the need for a big lump sum. Now, the downside to this strategy, based on research from Vanguard, which looked at the MSCI World Index returns between 1976 and 2022, actually showed that lump sum investing outperformed cost averaging 68% of the time. Now, that strategy works if you have a big lump sum available to invest. Say you've had a big bonus from work, or perhaps you've inherited some money, perhaps even you've been lucky enough to win the lottery. But for me, I can only rely on my monthly income and build up my investments slowly over time, because I'm not in a position where I've got a big lump sum available to deposit and then simply never look at it again. How much you invest is of course very personal, but one concept that I wanted to share with you today is compound growth, because that will be the thing that massively grows the value of your money over time. And it is always a case where the more money you have, the better off you'll be. So let me share with you a few examples to bring this to life. We'll take a look at the real rates of return of the US stock market, so it's inflationary adjusted, of 6.6%, which we've taken from the Dimpson, Marsh and Staunton research, and we'll also assume a 30-year investment time horizon. In that case, here are the respective portfolio values if you invested 100, 250, 500, 1,000 and 1,500 pounds a month. As you can see from the compound effect, the value of your portfolio really scales up with the more money that you have at your disposal. But of course, do remember that when investing, your capital is at risk. Now, for awareness, whilst this is one way to forecast future growth, the market never provides a consistent rate of return year in, year out, as you can see from this chart. And therefore, there are certainly some flaws with this compound model that I've just presented, but nonetheless, hopefully you get the idea of how this concept works in practice. And if you do want a real life example of how compounding does truly work, then take a look at this example from Warren Buffett, whose net worth has just increased massively decade on decade. I definitely won't be a billionaire within my lifetime, but hopefully I can compound into at least a few 100,000, if not maybe even the early millions if I'm truly optimistic. And that would certainly give me a very happy retirement. Now, if you are new to investing, then I recently made a video where I shared everything I've learned over the past 8 years, which you can check out by clicking this video next, but be sure to subscribe to the channel on your way out. And with that being said, I'll see you over in the next one.